Hi everyone, today I'll be breaking down stock market indices. I got a question recently from a subscriber who's actually a PhD of mechanical engineering and is the co-founder of a biotech startup, but that's besides the point. He was asking, what is the Nasdaq? What does it mean? What is the Dow Jones and how do I invest in it? Should I even invest in it? If you already know what indices are and you want to jump right into which ones to invest in, check out this annual ETF video I made a few months ago. I'll revamp in a few months as well. I love getting questions from beginners because it gives me video ideas. It shows I'm taking my experience for granted. I don't know what the viewers know, and some things I think are common knowledge are clearly very niche. So today's topic, I'll be breaking down and explaining the most common indices, some pros and cons of each, and actually how to invest in each. This will be from the Canadian investor point of view, but hopefully it's applicable to everyone. Please like the video and subscribe to the channel. Before I get started, a brief message from today's sponsor. We all know our economy's been on a wild ride lately with inflation and interest rates doing the tango. It's like every dollar needs to work overtime just to keep up. I've been exploring Moomoo, a global trading platform in Canada. Moomoo is a member of CIRO and CIPF. With Moomoo, you can trade on the global market all from a single account. Stocks, options, and ETFs anywhere, anytime with no extra account fees. As for trading fees, I know no one likes to talk about them, but the fees matter as they can take a big bite out of your profits. While most of the Canadian brokers charge anywhere from $4 to $9.99 per trade for US stocks, Moomoo charges are only $1.99 per trade. And even better news is that if you sign up today, you can trade with zero commission for 2 months, as Moomoo is giving out the commission rebate card that is worth $2,000. The commission you spend in the first 60 days under this amount will be refunded to your account. If you're not ready to dive into the stock market yet, the Cash Plus program they're offering is also worth trying. If your idle funds are still sitting in the bank, you're likely only earning 2 to 3% yield per year. Join Moomoo's Cash Plus plan today and you can enjoy a time-limited 6% yield on cash under 10K and an always-on 2% yield on all your excess cash. Your money compounds daily and is paid out weekly. This rate is almost the highest on the streets in Canada. I certainly wouldn't miss this. Moomoo supports TFSA and RSP as well as cash and margin accounts. Use my link to register now to get the $2,000 commission rebate. If you make a deposit of $2,000, you'll receive a $200 cash rebate on stock trades. And don't forget the 6% APY idle cash booster. Keep in mind that this promo is limited time only. Starting off with, what is a stock market index? I actually had to look up the definition. It is a list of stocks of public companies grouped in a certain sector or geographic location. And I'll give a few examples later. Indices help investors understand market trends and make informed decisions. It also helps investors compare their portfolio to see if it's doing well or not. For example, the TSX Composite Index represents the performance of the largest companies listed on the Toronto Stock Exchange. If this index goes up, it generally means the Canadian stock market is doing well. I'll be talking about the 4 or 5 most popular indices: the TSX, the S&P 500, the Nasdaq, and the Dow Jones Industrial Average, or Dow Jones for short, or Dow even shorter. There are hundreds of indices like DAX, which is German, and Nikkei, which is Japanese. You can't actually invest directly in an index. You have to buy a fund that mimics the index, again, referenced in that same video I mentioned previously. When someone says you should invest in the TSX or invest in the S&P 500, they mean in an index fund. Like if you search right now, S&P 500 index, it shows 5,600 US dollars. You can't actually give someone 5,600 to invest in this directly. I'll explain how to later on though. Now I'll explain the 4 most popular ones and the ones I actually want you to invest in. The S&P 500, you've probably heard me talk about this over 100 times on this channel before. This is a list of the 500 largest companies in the US. If you want to learn how to invest in it, I made a video a few years ago. I'll be revamping this video in the coming weeks though. This is defined as the market. When someone says the market is going up or down, they don't mean the Canadian market. They mean the US and they mean specifically the S&P 500. Investing in this index should get you an average of 9% per year. If you're investing in something and you're getting less than 9%, you're not beating the market. you're even missing out or losing out in comparison. It's good to invest in this for beginners since you're getting a wide array of industries like tech stocks, healthcare stocks, telecom, or even financial. I'll throw up this website, Finvis. I'll link it also in the description just so you can get an idea of the size of each. Even though this is US based, it contains global companies like Apple, Google, Amazon, so you're getting global exposure. The downside is that it's in USD, so if you're Canadian or abroad, there are currency fluctuations that you'll have to deal with. You can invest in the S&P 500 by buying the following funds. SPY, which is the most popular, VOO and IVV, those are in USD. Then in Canadian dollars, there's VSP, VFV, and XSP, just to name a few. The Nasdaq is the second most popular. This one gets confusing because it's both a marketplace and it's an index. The Nasdaq marketplace is the stock market that has over 5,000 stocks that you can purchase, but we won't be focusing on this. We'll be focusing on the Nasdaq composite, which is around 3,000 stocks. Even more confusing is the duplication of stocks. Like Apple is part of the Nasdaq index and it's in the S&P 500. So if you invested in the Nasdaq and the S&P, you'll be doubling up on some stocks. The downside of the Nasdaq is that it's mainly tech and biotech stocks, so not much diversity in terms of investment, but the returns in the past few years have been great. The issue is past performance is not an indicator of future performance. Take that with a grain of salt. If you want to invest in the Nasdaq, you'll need to invest in an index fund. I would use QQQ. Keep in mind this is in US dollars and it's around $480 per share. Next on the list, the Dow Jones Industrial Average, or Dow Jones for short, or Dow even shorter. This one is very different. It's only 30 stocks, and this one includes Apple as well. So if you invested in SPY, QQQ, and the Dow, you're indirectly holding Apple 3 times, which is fine, but it's just a heads up that there is duplication. The Dow Jones is 30 significant US companies, often seen as a barometer of the US economy. This list is chosen by a committee, whereas the S&P 500 is chosen by a formula and based on financial performance and market capitalization, which basically just means the size of the company. The Dow is good because it contains successful and stable blue chip companies, but since it's also only 30 companies, it could be more susceptible to large swings just based on one company's performance, like Apple, given it's so big. Some notable names are Coca-Cola, McDonald's, Nike, Johnson & Johnson. You can invest in the Dow by using the ETF DIA. This one is also in US dollars and it's currently around 411 USD per share to invest in. Lastly, we have the TSX Composite Index. Investing in a TSX fund means you're investing in the top 250 Canadian companies. Some pros include diversification. It covers multiple sectors like energy, financials, and telecom. You get stability. It includes well-established and well-performing companies like TD Bank, RBC, and BMO, and maybe let's say even Rogers and Bell. Some cons is that it's finance heavy, meaning it's super reliant on the big 6 Canadian banks, which can make it more volatile when this sector fluctuates. Even though the banks are considered super safe and stable in the past, there's no guarantee it will always be this way. If you want to invest in the TSX index, you can use XIU. This ETF mimics the performance of the TSX composite. Hopefully that wasn't too confusing. I'll probably spend the next video recreating an older S&P 500 video. I'll explain how Canadians can invest in the S&P 500 in USD or CAD if they want, and maybe the pros and cons of each, because there are certain tax consequences if you do TFSA or RSP, and I'll make a few recommendations. That's it for this video. Thanks for watching and tune into the next one.